Welcome to this video series about measuring value creation in private equity, where we talk about how thoughtfully deployed ESG initiatives, or the opposite, can drive private equity returns. My name's Mike Reinert. I've worked in the industry for over 15 years. I wrote the book Private Equity Value Creation Analysis, and I run the AUXILIA Mathematica and ValueBridge.net websites. These videos are designed for private equity practitioners who use data to raise capital or evaluate the returns of private equity deals, funds, GPs, and investment programs. If it is helpful to you, subscribe and check out the website, where you can download Microsoft Excel files for every episode. This is video number 17 in the Value Creation series, where we look at methodical ways to measure the impact of environmental, social, and governance initiatives, or ESG, in private equity deals. This has obviously become a huge topic in recent years. Thousands of executives now have ESG in their titles, and they collectively earn billions to implement and monitor ESG within their organizations. Despite this, you will not find much agreement about what ESG means, how to measure it, what the measurements mean, or what should be done in response to those measurements. I think that's because at least some portion of what gets labeled as ESG is BS. It gets popular, so marketing efforts naturally coalesce around it. I think that another and very large portion of ESG is real but unmeasurable. It consists of qualitative factors that do not translate to income statements, balance sheets, valuations, or investor ROI. However, I think that there's another segment of ESG that is both real and quantifiable, and that's what we'll focus on in this video. Before we dive into that, let's consider how some of these ESG conversations get started in the context of a private equity fund. Here we have a big Canadian pension receiving a visit from a middle market buyout GP, let's say from the Intermountain Western US. The GP has great news to share. They're about to launch a new ESG fund, the SP Distressed Eco Buyout Sustainable Special Situations Fund 5 LP. And they also claim that from here on out, all of their funds will be ESG focused. So the LP says, hey, that's great. Like a lot of the pensions up here in Canada, BCP has been a pioneer in supporting various ESG managers and ESG initiatives. Can you tell us, how do you expect this to impact your returns? So the GP responds, absolutely, we're glad that you asked. We're confident that by shifting to a 100% ESG focus, our returns, and you might want to sit down for this, will be even better. We've backed all 4 of your prior funds, right? Yes. We've committed almost $250 million across your platform, right? Yes, and we really appreciate You mean to tell us that all this time, you've been destroying the environment and delivering worse returns? So if you take that line, don't be surprised if you meet with some skepticism. Presumably, there must be some trade-off between investing in a more ESG-friendly manner and ROI. Otherwise, everyone would be doing it. A different conversation might look like this. Hi guys, great to be back here before the BCP Investment Committee. You may recall us showing you a version of this chart in the past. Oh sure, that's the one that explains the sources of your returns. That's right. In the past, we've calculated that across our portfolio, 40% of our equity returns comes from increasing portfolio company EBITDA, 20% comes from expanding portfolio company valuation multiples, 20% comes from portfolio company cash flows, and the remaining 20% comes from using moderate portfolio company leverage to amplify equity gains. Well, we have since rolled up our sleeves and dug a bit deeper with an eye towards ESG factors, and candidly, mistakes were made. It turns out that these value drivers really only account for about 80% of equity value creation. And this gap right here might be loosely defined as environmental destruction and social strife. Now, certainly this was never the intention of our value creation plans, rather an inevitable consequence of pursuing various profit-maximizing pathways in a global economic environment. However, we believe that going forward, we can shift to more ESG-compliant value creation mechanisms and essentially eliminate the destructive elements of our prior approach, providing an equity return value creation profile that looks more like this. Wow, that is quite impressive, really a remarkable amount of detail and disclosure. Can you tell us, how much do you think this will impact your returns? Absolutely, we're glad you asked. Historically, our funds have returned about 2x net after fees, expenses, and carry, with a net internal rate of return of about 21%. It is quite easy to show that if you go back and make various pro forma adjustments to remove the environmental destruction and social strife, our ESG compliant returns will be closer to 1.6 and 15%. We hope that you'll agree that this is a reasonable trade-off for investing in a manner that makes the world a better place. Now, those last 2 examples represent extremes. I'm sure that GPs can create value through certain ESG initiatives, but I think that a cost-benefit analysis that methodically shows how ESG initiatives flow through to company income statements, balance sheets, and valuations will make the GP's argument more convincing. Well, that is precisely what the value creation models in the book and on the website are designed for, so we can use that math to make methodical measurements of ESG in private equity deals. Let us first do a quick refresher on how these models work. We typically start with a set of capital structure and P&L metrics like this. Here we have company values at entry and exit. Then we look at how these values change over time, calculating various changes, averages, and multiples as follows. We can then use this data to create a value bridge that explains all the sources of change in the GP or fund's investment value. For example, the third value driver on this chart represents gross margin expansion, and it's given by the following equation. The 2% increase in the company's gross profit margin times the average holding period revenue, valuation multiple, equity ratio, and fund ownership percentage tells us that the gross margin change created precisely $3.9 million of equity value for the GP. Now, instead of just looking at capital structure and P&L changes over a holding period, we can use the same math to evaluate companies before and after certain ESG initiatives are implemented. This lets us methodically measure how ESG influences the return. As a warning, we will rip through these examples quickly. They are technical and assume familiarity with the value creation models in the book and on the website. If you start to get lost, go to the VC117 episode page where we lay out all the data and equations for the different scenarios. On the site, we also provide a Microsoft Excel template that you can download and an online calculator where you can plug in data for your own companies and measure how ESG factors impact your equity returns. So let's start here with a baseline example. The GP makes a $30 million investment. They own 60% of the company, giving us $50 million of total equity. Net debt on the company's balance sheet is $50 million, so the total enterprise valuation is $100. That gives us an equity ratio of 50% and a debt ratio of 50%. Looking at the income statement, we see the company has TTM revenue of 80, gross profit of 48, and EBITDA of 20. That makes the valuation multiple 100 over 20, or 5.0, the EBITDA margin 20 over 80, or 25%, and the gross profit margin 48 over 80, or 60%. The last value we need is the operating expense margin of 35%. This represents the company's SG&A divided by its revenue, but it's also equal to the gross margin minus the EBITDA margin. Okay, from here we could start layering on various ESG initiatives and watch how they influence the fund or GP's equity valuation. First, let's look at initiatives that would reduce a company's gross profit margin. This might come from sourcing more expensive materials or inputs in a manufacturing process, perhaps because they are more sustainable or come from countries or regions that pay workers higher wages. It explains anything that would increase the unit cost of delivering products or services to customers. For example, if you planted a tree for every unit sold, it would show up here. Now, let's say that because of these initiatives, the gross profit margins will drop 2% from 60% to 58%. This means that the company's EBITDA margin must also drop 2%. Here it goes from 25% to 23%. Assuming the company's top line remains at $80 million, the gross profit must go to 46.4 while the company's EBITDA goes to 18.4. If we assume that the valuation multiple remains the same at 5.0, the company's total enterprise valuation will drop to $92 million. Net debt doesn't change, so the company's total equity value reduces to $42 million. And this makes the company more levered, so the equity ratio goes to 45.7% and the debt ratio goes to 54.3%. Finally, if the 60% ownership does not change, then the GP's equity value will drop to $25.2 million. This represents a 16% decrease in the value of the GP's investment. The equity value decrease has two fundamental causes, and we can measure them by adding the differences and averages to the table. The first is negative gross margin expansion, or what we might call gross margin contraction. Minus 2% times the average revenue of 80, valuation multiple of 5.0, equity ratio of 47.8%, and ownership percentage of 60% gives us negative $2.3 million of gross margin expansion. The other cause is gearing. Because we have debt in the capital structure, when we lose enterprise value, we lose even more equity value. The amplification of equity losses in this case is equal to the $8 million drop in the enterprise times the average holding period debt ratio of 52.2% and fund ownership percentage of 60%, giving us negative $2.5 million of gearing. Note that these two value drivers add up to the GP's total equity loss of 4.8, and it explains how reducing the gross margin and holding everything else constant reduces the GP's investment by 16%. Next, let us consider some ESG initiatives that increase the company's SG&A as a percentage of revenue. After all, we'll need to hire people to implement and track all these initiatives, and perhaps we're also running facilities that cost more because they're more ecologically friendly or they require additional spending to reduce their carbon footprint. This really includes anything that increases the fixed cost of delivering products or services to customers. So let's increase the SG&A to 37% of revenue instead of 35% of revenue. The 2% increase will reduce the company's EBITDA margin by another 2%, so that now goes from 25% to 23% to 21%. Assuming the company's top line remains at 80, EBITDA will now be 16.8. If we assume the valuation multiple remains the same at 5.0, the company's total enterprise value will drop to $84 million. Net debt does not change, so the company's total equity reduces to 34. And this makes the company even more levered, so the equity ratio goes to 40.5% and the debt ratio goes to 59.5%. Finally, if the 60% ownership does not change, then the GP's equity value will drop to $20.4 million, and this represents a 32% decrease in the value of the GP's investment. Adding the differences and averages to the table show us that this time we have three causes. Gross margin expansion is calculated as before, providing negative $2.2 million of equity value creation. Operating margin reduction is equal to minus the 2% increase in the operating expense margin times the average holding period revenue valuation multiple equity ratio and ownership percentage. This also gives us negative $2.2 million of equity value creation. And now the bigger drop in enterprise valuation and larger average holding period debt ratio will give us a bigger loss due to gearing. Here it's negative $5.3 million. We can see that these three values add up to the GP's total equity loss of $9.6 million. And that's how certain ESG initiatives that increase COGS and SG&A can reduce the value of a GP's investment by almost 1/3. So these are two ways in which ESG initiatives can negatively impact equity returns. Let's look at some positives. Let's say that due to providing more ESG-friendly products and services, the company can increase revenue by raising prices, selling more units to customers, or a combination of both. Let's assume that the new ESG positioning increases revenue by 10% to $88 million. At the stated margins, that makes the gross profit go to $51 million and the company's EBITDA go back up to 18.5. If we assume that the valuation multiple remains the same at 5.0, the company's total enterprise valuation will be 92.4. Net debt is unchanged, so the company's total equity value becomes 42.4, and this makes the equity ratio 45.9% and the debt ratio 54.1%. Finally, if the 60% ownership does not change, then the GP's equity value will be $25.4 million. This represents a 15% decrease in the value of the GP's investment. Adding the differences in averages to the table show us that this time we have four causes. A negative $2.4 million loss due to gross margin contraction, a negative $2.4 million loss due to operating margin increase, but now we have positive equity value creation from revenue growth. This is equal to the $8 million revenue increase times the average holding period EBITDA margin of 23%, valuation multiple of 5.0, equity ratio of 47.9, and ownership percentage of 60%. The equity value impact of increasing that revenue is $2.6 million. And then finally, we have the negative $2.4 million loss due to gearing, which is calculated the same as before. These values add up to the correct GP total equity loss of $4.6 million. The loss is driven by decreasing the gross profit margin and increasing the operating expense margin still hurt us, but now they're mitigated by corresponding improvements in the company's top line. So the GP's investment only decreases by 15%. Now let's look at another potential positive effect of ESG. Perhaps, due to the company's improved ESG positioning, it could demand a higher value in the marketplace in an M&A process. Its EBITDA and revenue streams have become more valuable. Instead of being valued at 5 times its TTM EBITDA, it's now worth 5.5 times TTM EBITDA. This is a 10% increase in relative valuation, and it makes the company's enterprise valuation increase to 101.6. Net debt is still at 50, so the company's total equity increases to $51.6 million. And this makes the equity ratio 50.8% and the debt ratio 49.2%. Finally, if the 60% ownership does not change, then the GP's equity value will be $31 million. Now we finally have an increase in GP equity value, a whopping 3%. Negative $2.7 million comes from gross margin contraction, negative $2.7 million comes from operating margin increase, positive $2.9 million comes from revenue growth, and multiple expansion is equal to the 0.5 increase in the valuation multiple times the average holding period EBITDA at 19.2, equity ratio of 50.4, fund ownership percentage of 60%, giving us positive equity value creation due to multiple expansion of $2.9 million. Finally, this time we also get positive gearing of $0.5 million driven by the $1.6 million increase in the total enterprise valuation, 49.6% debt ratio, and fund ownership of 60%. These values add up to the correct GP equity gain of $1 million. Here, the equity value losses driven by decreasing gross profit margin and increasing operating expense margin are now fully mitigated by corresponding improvements in the company's revenue and valuation multiple. So we end up with a more ESG compliant company and the GP's investment increases by 3%. All right, let us add one more ESG wrinkle to this example. Let's say that for every deal, the GP commits to donating 1% of equity proceeds to some ESG-worthy cause. That doesn't change any of the company capital structure or P&L metrics, only the final ownership percentage, Phi2, and the final fund equity value, FEC-V2. To this model, we'll just multiply the final ownership percentage by 99% to get a post-charitable giving ownership of 59.4% and an exit fund equity value of $30.7 million. Adding the differences and averages to the table shows us that this time we have 6 causes. Gross margin contraction of minus 2.7, operating margin increase of minus 2.7, revenue growth of plus 2.9, multiple expansion of plus 2.9, gearing of plus 0.5, and finally the 0.6% decrease in fund ownership times the average holding period equity valuation of 50.8 gives us fund ownership impact of minus 300K. These value drivers add up to the GP's equity increase of 0.7 million, and I think that's a pretty complete explanation of how you can implement a number of ESG initiatives that reduce your margins, but still end up growing equity value because they can help you sell more products or services and price your company at a higher valuation. Of course, we might do better than this. If the initiatives allow us to grow revenue by 20%, then the exit revenue will be 96 million. This increases the gross profit to 55.7 million and the EBITDA to 20.2. And if we can also increase our valuation multiple by 20% to 6.0, this will make the total enterprise valuation 121 million. With net debt of 50, we'll have total equity of 71 million, an equity ratio of 58.7, and a debt ratio of 41.3. Finally, with an ownership percentage of 59.4, equity proceeds for the GP will be 42.2 million, resulting in 12.2 million of equity value creation, a 41% increase in the GP's investment. Here we can add our metrics to the table so we can calculate a loss of 3.1 million due to the lower gross profit margins, a loss of 3.1 million due to the higher operating expense margins, a gain of 6.6 million due to higher revenue, a gain of 6.5 million due to higher valuation multiples, a gain of 5.7 million due to debt's amplification of the equity gains, and finally a loss of 400K due to the GP directing 1% of their equity proceeds to some ESG-worthy cause. As expected, these value drivers will add up to the 12.2 million increase in the GP's investment. So that demonstrates how value creation models can be used to evaluate the impact of ESG initiatives in private equity deals. Of course, we could have set up these spreadsheets differently. Instead of driving income statements with margins, we could have plugged in the absolute value of COGS and SG&A. We could break up that revenue growth value driver to model baseline growth that would have occurred anyway and the incremental growth that was driven specifically by ESG. And we can also split up multiple expansion to separate the value driven by broader market forces and valuation changes that are specific to the company. Anything is possible once you get the math right, which is why we wrote a book about these value creation models and why we spend so much time talking about them here and on the websites. If you are interested in this sort of thing, please like, subscribe, and check out the private equity value creation videos on AUXILIA Mathematica. Registration is free and gives you full access to downloadable Excel templates, articles, white papers, online value creation calculators, and other content. Now, if you need to set up models like this in a hurry, perhaps for a GP annual meeting presentation or a manager due diligence project, I encourage you to check out valuebridge.net. This is a new website that skips all the mathematical proofs and theories and gives you just what you need to build defensible private equity return models in a couple of hours. At valuebridge.net, we break everything down into 40 efficient modules, and you can filter by topic or value driver to find the one that specifically suits your needs. Every module includes a Microsoft Excel template, a short video that shows you exactly how to use it, and an online calculator that you can use to make sure that your model is giving you the right answers. It is a paint-by-numbers toolkit that takes all the guesswork out of the private equity value bridge. Thanks for watching. I hope to see you either at AUXILIA Mathematica or valuebridge.net.